So we're going to talk about mutual funds. The project's all about mutual funds, so we're going to talk about that in this lecture. And I don't think it's going to take us very long because you do talk about mutual funds a lot in your other classes, so I think you're pretty familiar with them. But let's talk about some of the things that you might not have thought about with mutual funds. So first of all, mutual funds have different categories of expenses that you need to be aware of. One is the operating expenses, and of course, all funds are going to have operating expenses, but they tend to be lower for the passively invested funds, the passively managed funds. So, so you'll have lower operating expenses typically for those. Uh, Loads, you want to avoid loads if you possibly can. You can almost always find a fund that invests with your objective that doesn't have a load. And what a load is, a front-end load actually takes your money before it goes into your account. So if I invest $100, um, they're only going to put 95 in my account if the load is 5%, which is kind of crazy. So you already start out at a loss. So that's a really bad idea. A back-end load, I invest $100, they put $100 in. I take the money out. When I withdraw the money, let's say it's 110 by then they charge me a load at the back end. So they've charged me 550, and I'll get a lot less money than I would if I didn't have that load in terms of return, especially. And then my contingent deferred sales load is a type of back end load and this is usually what you'll have when you have a back end load where the load decreases. So if I take the money out in the first couple of years, I pay a back end load. If I keep it in for 5 years, the load is zero, but it declines in the first 5 years. So it continues to decline. 12B1 fees are the yearly marketing expenses. Every fund has them. And then if you take all expenses divided by the asset value, you get the expense ratio. It's typically 1 to 1.5% for managed funds, lower than that for passive funds and ETFs, exchange traded funds, which we'll talk about in a minute. So here's an example of some managed funds, growth funds and value funds. There are others. A growth fund is one that invests in stocks that have low to no dividends and higher beta because their objective is to find companies that are growing and they're planning to grow. So they're not paying out dividends because they need their cash to grow, and they typically have more risk than value stocks. Value funds invest in stocks that have a higher dividend yield, uh, and they'll have relatively low PE ratios because they don't have as much anticipated growth. Index funds follow either a stock index or a sector index. The sector index, or the so this would be, for example, I would follow the Dow Jones Industrial Average. So my objective as a fund is to try to mimic the S&P 500. Sector index could be I'm trying to mimic the Dow IT, Information Technology Index. The So there are a bunch of different indexes that you may not be aware of that measure these healthcare and things like that. Exchange traded funds are funds that trade very much like stocks. You can buy them anytime during the day, and you just buy them on the stock market or sell them on the stock market. And the great thing about exchange traded funds is they have very low expenses. So they have very low expense ratios, and they usually save a lot of money. Oh, sorry. Sector funds are funds that invest in a particular sector because that's what you want to invest in. So you're really interested in that sector, the information technology sector, the healthcare sector, the financial sector, something like that. And then geared index funds are we're going to talk about more when we do the project, but those are funds that try to say, for example, where an index fund would mimic the S&P 500, a geared index fund would double the S&P 500. So that would be like an ultra fund. That would be called an ultra fund. And then a short fund would try to do exactly the opposite of the S&P 500, and an ultra short fund would try to magnify that opposite of the S&P 500. So how do we measure performance for mutual funds? We're going to look at the fund objective. So we're going to compare funds across the similar fund type. I wouldn't compare an S&P fund with a bond fund, for example. They shouldn't have the same return. I want to look at the risk that they're taking, and I want to make sure that they're taking the risk that I expect them to take. That if they're invested in the S&P 500, they're taking a risk similar to the level of risk that the S&P 500 gives me. And then what's the benchmark? I want to measure them against a benchmark that's a fair benchmark given the objective of the fund. So performance measures that we use are alpha, Sharpe ratio, and Treynor ratio. So alpha is where the firm plots on the securities market line, the equation of the CAPM. So as you know, the equation of CAPM looks like this. This is the T-bill minus the plus the beta times the market risk premium. And I take the return and I subtract that CAPM predicted return from the return on the stock. The Sharpe ratio takes the return on the stock, on the fund, I said stock, minus the T-bill, the return on the T-bill, and divides by the fund's standard deviation. So that's a measure of total risk. So it's how much return am I getting, excess return am I getting over and above the T-bill rate, divided by the standard deviation of the fund. And to go back to alpha for a minute, this is telling me how much return I'm getting over and above what I expect to get given the risk I'm taking measured by beta. And then the Treynor ratio tells me something similar, which is the return minus the T-bill return. So that's the excess return over and above the T-bill divided by the beta of the fund. So I want to look at the Sharpe ratio of an IT index fund compared to the Sharpe ratio of another IT index fund. So I'm not trying to compare across different fund types. And I want to look at the Treynor ratio and the alpha for those fund objectives. So I'm not going to compare a bond fund again against an S&P index fund or a sector fund. And then let me just give you some examples. So here's how we do this. The T-bill, so if the T-bill is 2% and the market risk premium is 6%, I'm going to calculate alpha this way. And I'm just going to do Mariner, you can do Angel. So alpha is 9.2 minus the return that I would expect given the CAPM, which is equal to 2, I'm going to put this in parentheses so I can use a plus, but that's bad, plus the beta, which is 1.1, times the risk premium, which is 6%. I'm not going to use percent because I didn't use percent on the other ones. So I'll go back, times 6. Okay? You can calculate that. The Treynor ratio, let me do the Sharpe ratio first. Sharpe ratio is, just to keep them in order, the Sharpe ratio is equal to 9.2 minus 2 divided by standard deviation, 12, and the Treynor ratio is 9.2 minus 2 divided by 1.1. So that gives you a measure of systematic risk, relative systematic risk. This gives you a measure of relative total risk. So that's about all I have to say about mutual funds. See you in class.